get what is expected.
Throw a couple $1 trillion at the market, and now you're going to pull it back, and you wonder why the market is down. All right, your next test warns the market maybe on a one-way trip to misery. Jim Bianco runs Bianco Research. Wish I had some better news for our audience, Jim. How do you define misery? It's already felt pretty miserable.
Yeah, because it's some of the comments that I've heard earlier today. The Fed only has one tool to bring in inflation, and that is that they have to slow demand, and that is they have to make the stock market miserable. Now, they're giving an out because we're in a bad news is good news scenario because you got 390,000 jobs in May. So they feel like they could make the stock market miserable without creating unemployment. So we might not like what's happening, but over in the Eccles building in Washington, I don't think they're too upset with what they've seen in the stock market for the last few weeks, and they want to see a little bit more of it because they want all of us to stop spending money, and then we can have the demand for stuff peak, and we can have inflation come back down. It's all they've got right now.
Is there any indication that higher rates on any part of the market are going to do that, Jim? And if so, when?
Sure. I mean, you could raise rates enough and you can butcher the economy and you can have demand fall off a cliff and you can have inflation go down. Now, that's not the way you and I want it to be done. And the Fed thinks that they could do this and create a soft-ish landing. So they've gone from soft to soft-ish landing. But, the odds are against them. And yes, what you're implying, I agree with. There's a high degree of chance that they're going to wind up going too far and making a bigger mess of this. But again, the president ordered them 2 weeks ago in the White House to do something about inflation. They said they would. They cannot throw their hands in the air and go, I'm sorry, I can't do anything about this.
Is there part of the bond market? I referenced mortgage-backed securities, Jim. I don't know if you follow them. I'm looking at pricing models, getting notes. They're back to 1985. Prices for MBSs have kind of collapsed. We're seeing these huge liquidity issues in other parts of even the government and repo bond markets. I just wonder what that is all telling you. Are we sort of on the precipice of a larger credit issue?
Well, yeah, I think that the bond market, and I'll use a very technical term, it's a complete mess right now, what's happening in the bond market. The total returns, the losses that you've seen in the bond market year to date are the greatest ever. This is shaping up to be the worst year in bond market history. The mortgage-backed market is no better. Liquidity is terrible. And one of the reasons why that's happening is, well, two reasons. One, you've got quantitative tightening coming. The biggest buyer of bonds is leaving, and that's the Federal Reserve. And you've got them intending on being very hawkish in raising rates. Look, the market, the Fed Fund Futures is pricing a 100% chance they're going to raise rates 75 tomorrow. They've never failed to deliver on a 100% pricing. And it's got a 90% chance that they're going to raise rates 75 again in July. So in the bond market, it's understandable that it is a mess because everything is a one-way street in the wrong direction right now.
Hey, Jim, it's Tim. Let's talk about how you play this. I read your notes. You talked about commodities being one of your top plays. I would agree with that. But how do you push back on critics that would say demand destruction is the other side of all of this, even for commodities that have some structural reasons why they're higher today?
Well, you're not there in demand destruction yet. And so I think that until you do, commodities will continue to go higher. But the caveat I would give people about commodities is they've got crypto levels of volatility. So you better be prepared for 5, 8, 10% days in a lot of these commodities, because you've seen that quite often in things like crude oil. And so it's not going to be for the faint of heart that you want to play commodities. But if you're looking for something that has been working this year with a lot of volatility, it has been commodities.
Jim Bianco, Bianco Research. Jim, we appreciate the technical jargon. A complete mess. Jim, thank you very much. Karen, final word to you.
Well, it's interesting. I mean, commodities seems to be where